Alrighty, so in the previous lesson, we looked at the actual mechanics of the market. So the mechanics of how order flow, which is the interaction between buyers and sellers, that battle of supply and demand, that is what leads to the price action that we see on our candlestick charts, right? So what we're going to do today in this lesson is now we're going to start to look at how we actually draw and identify these areas of supply and demand in the market on our candlestick charts, and how we can use those as high probability trading opportunities when we combine them with everything that we know so far about market structure. Okay, so that's more sort of what we'll do throughout the next lessons in this course. But this lesson now is where we're going to start to look at how we actually just identify these zones in their most basic form. Okay, as we go through the lessons, we'll then learn how we actually refine these and try and make them more and more high probability. Now, just going to kick things off with a bit of a riddle. So let me just type this out. Time doesn't know price, and price doesn't know time. Okay. No expenses were spared in the creation of animations in this lesson. Okay, cool. Fancy words. What does that actually mean? Time doesn't know price, and price doesn't know time. So I know at first it sounds like some silly riddle that you might be trying to get your head around, but really I think it's quite simple. And I guess the point I'm trying to make here is, and this is something I was sort of guilty for quite a long time. As retail traders, we can get quite caught up in our world of technical analysis and looking at our candlestick charts. And we can be forgiven for thinking that everyone else who participates in the Forex market, they must be trading in a similar fashion to us, right? They must be looking at candlestick charts and drawing their zones on and market structure and all those things. But if you think about what we just discussed in the previous lesson on market mechanics, and you think about the order flow in the market, so that's $7 trillion that goes through the market every single day, right? There's literally no way our human brains can even begin to imagine how much that actually is. But if you think about all of that volume going through the market, and institutions, let's say, are the big players who are putting the majority of that volume through, they're not necessarily trading with a chart, analyzing and waiting for candle closures and drawing on their highs and lows and things like that. The majority of them are just putting orders through the market, and they're just transacting, commercial volume. So a lot of the big dealing desks, they're just working through that commercial volume that comes to them to facilitate transactions for endless amounts of reasons, right? Let's imagine big European investment firm, and they want to buy a load of real estate, a load of property in America. What they're going to have to do, they're going to have to sell their euros to exchange those for dollars to then purchase the American real estate, right? So then they'll go to their institutional bank, who will then process that transaction for them to exchange their euros for dollars, right? Now, on top of all of that, because obviously there's going to be millions of different reasons and examples like that, you're then going to have complicated algorithms who are continuously layering orders in the market, right on top of each other. So whether that's for pure speculative strategies or purely just from market makers whose job it is to provide liquidity to the market, there's a lot of complicated, not complicated, but there's tons and millions of reasons as to why money's being exchanged in the market. So what we can do is we try to make sense of all of that complicated interaction and that interplay of all of those orders, of that battle between supply and demand, between buyers and sellers. And we do that and we make sense of it with candlestick price charts. The reason why is very simply, they help us to visualize all of that complex interaction in a much simpler format once you understand how to actually read it and interpret it. So the first step to doing this is simply by understanding what a range is. Now, a range on a price chart is simply just a sideways consolidation or correction, right? So we can just see prices just moving sideways. It's not really moving in any sustained direction. It's not breaking the high or low. We can see that price never trades higher or lower than its low, right? It's pretty much contained within there, right? I think that's pretty simple. So what's happening is buyers are stepping in whenever price dips into what they deem to be cheap pricing, discount pricing, and they're stepping in and buying up price. And then as it moves up into what's deemed by the market as more premium pricing, players think it's too expensive here. The sellers are then starting to step in. Now, ranges can obviously be found on all time frames, and this is where sometimes just jumping up a time frame can show you more clearly that price is actually stuck in a range sometimes if you're too zoomed in on a lower time frame. Now, when price is stuck in a range like this, and it's essentially just moving up and down, that can be viewed as the market deeming the price to be at fair value, right? So it's kind of just trading around that area. Buyers and sellers, pretty much just think that that's the price it should be at for a sustained amount of time. But eventually, as you probably know, there will be an overwhelming imbalance between supply and demand. And this is when you will then see, that rapid and large expansive breakout of the range with high volume, either to the upside or the downside, depending on who is in control. So when we see that rapid movement away from the range, that basically suggests that typically high volume has entered into the market. A lot of orders have exchanged hands, and there was likely institutional backing, because it takes a hell of a lot of money just to move any of the major currency pairs by even just 1 pip. So if we see price rapidly breaking out of a range like this, that really gives us our first clue of a footprint that large financial institutions have stepped in, and they've caused that overwhelming imbalance between supply and demand. And then we can start to potentially frame a trade idea around this when we see this occur in the market, right? So price either breaking to the upside or to the downside out of a range like this. Because if price rapidly breaks to the upside like it does over here, then this is where demand has clearly overpowered supply, right? So what we do is when we see that initiation out of the range and step 2 has been completed, right? We see that impulsive break to the upside. This is then where we look for price to return to that range. And we essentially assume that there are going to be some resting orders left within this range. There's going to be more demand ready for price to fill. So we look for price to return to the range for it to mitigate those orders. So by mitigation, I simply just mean that price has tapped into the range. It's filled up some of those orders. And then if there is enough demand still left from within here, that's where we're then looking to essentially surf on the coattails of that large institutional volume. And we want to also look for long opportunities from within here to buy this and try and capture this continuation leg, right? This final step, this impulsive leg out of the range, okay? So if I could keep it more simple, you see price not really going anywhere, then price does go somewhere. So we assume that it must have taken a big player or a number of big players to push price up in that direction. So then we assume that there will still be a lot of demand left from within here, a lot of buy orders. So then when price returns, this is the area in which we want to be looking to get long to try and capture that next leg to the upside. And it's the exact opposite for supply. Range, price isn't really going anywhere. Someone must have stepped in, or not someone, but let's just say enough volume, or a more accurate statement would be there was an overwhelming imbalance between supply and demand for supply to overpower demand to break through these lows, right? Because there'll be demand from within here. It can push past it. It breaks out. We then assume that there's going to be supply or remaining sell orders from within here. So then when price returns, this is then when we look to get involved. We look for shorting opportunities to try and capture that continuation out of the range, okay? So range, initiation out of the range, okay? So we're not trying to capture this move. We'll wait for price to come back, because when this has happened, the market's already showed its hand, okay? So we're patient. We look for where there is their clear intentions. You'll hear me talk about this a lot in the live market. I say, I'm waiting for clear intentions. I want to see, where has someone stepped in? Where is a clear footprint, right? I don't want to be second guessing. I want it to be obvious. I'm patient. I wait for that to happen. Then what do? I don't sell down here, right? Be patient. Wait for price to come to me. I want to be selling at value. I want to be getting into the market where risk to reward is on my side. And then we look to short here. And then we look to try and capture that next leg to the downside, okay? So when these overwhelming imbalances between supply and demand eventually rises, that is when you obviously see those rapid moves in one direction out of the range, because at that moment, when you see price going to the downside, it's essentially trying to seek more orders to balance price. Because if price is moving rapidly in one direction, or in this case, it must mean there's more supply than there is demand. So those sellers are looking for people to sell to. And what do they need to make a trade? You need an equal and opposite transaction. You need a buyer. So it keeps rapidly moving until it can find a buyer. And then when there's more buyers and sellers, price will move to the upside. Then there'll be more, or I should say there should be more supply than demand at this point. So then price starts going to the downside, right? And it's continuously trying to seek where those next orders are going to be, that liquidity, until the market deems it's at fair value again. And then what will you see? You'll see price range, and we'll form another range. And then price might either break to the upside like this, or will range and it will continue and it will break to the downside, okay? And that's essentially the heartbeat of the market. So we now know how these zones are created and how they form in the market and what they represent. So they are visualizing the action of the order book, right? It's a visual way of us seeing the order flow of the market. And that's the language of the market that we are then reading with candlesticks. So how do we actually see and draw these on your charts? Well, if I can kind of give you the most simple tip of where to start, is you really just want to be looking for where is price sort of ranging or consolidating? Like, where is it paused? Where is it not kind of really going anywhere? Like, where is it taking a breather, right? It's not rapidly moving in one direction like this. We want to wait for like, when does it start to do this a little bit? Now, it may only be 1 or 2 candles. It may be loads of candles, but we're just looking for, where does that kind of, that break, that pause in price action start to happen? So that's where you want to see that. And then you want to look to see where price then rapidly breaks out of that range, okay? So when we think about it that way, if we keep things simple, there's kind of really only 2 main types of supply and demand zones that we kind of look at, right? We have a range created zone, or we have what's called a pivot created zone, okay? So hopefully it's reasonably self-explanatory, but with a range created zone, that's where we have, let's get my paintbrush again. We have this range creating, right? We have a consolidation, and then we wait for price to show its hand. We wait for it to commit to itself, and it breaks out of the range with momentum, right? That's kind of key. We want to see price really commit to itself. Again, remind yourself, what are we trying to do here with these funny shapes, these funny candlesticks? What it comes down to is we're looking for, where did overwhelming imbalances occur in the market? Where did that big money step in, right? Where did supply and demand take control? Okay, boom, there it is. I can see that, big something stepped in there, whatever you want to call it. Okay, cool. I want to try and surf on the coattails of that when price fills up more of the orders, and then boom, that's the move I want to capture. I want to capture this movement here, okay? That's all we're trying to do if you're kind of struggling to get your head around this. Okay, so when you see that consolidation and you see a push out, this is literally all you do to draw the zone. You just basically draw a box, whatever tool you want to use, and you draw it from the low of the range to the top of the range. And then we get that thrust out. And essentially that whole box there represents our supply range, okay? Range created supply range, whatever you want to call it. Exact opposite for demand, okay? So draw it from the top of the range to the bottom of the range to before where price breaks out, right? So that's basically your zone, but we drag it across because we then wait for price to return into it. And then as it comes in to that previous range and fills up the orders, this is where we can then begin to look for long positions to try and target that continuation after the mitigation, right? So the other sort of main type of zone we get is a pivot zone, right? So, this can be where typically you see price come down, and it could pause for 1, maybe 2, maybe 3 candles, right? And then we go. So it's kind of just looking for that move to the downside, right? A bit of a pause, a bit of a correction. And then what happens? Supply steps in the market to continue the move, right? And then that's why we look for price to come up into that area, fill up more of those orders, and then we try and capture that next wave, right? So it's kind of that pivot in the market. And sometimes it can be a reversal as well. So you get price coming up, right? And then it pivots to the downside. We're just looking for where basically something changes in direction. Okay, so with supply, you'll sometimes hear us refer to this as a buy to sell zone, BTS, a buy to sell zone. And basically what that means is price is bought and then it's sold. And basically that shows where, there's a not movement and then the sell movement, and that's where supply has stepped into the market. And we get the exact opposite for demand, okay? Where we have a selling pressure, and then boom, big buying pressure comes into the market. So we call that the sell to buy, okay? Because there's the sell portion before the buying portion, okay? It's a bit of a dumb name, but that's just what we refer to it. So yeah, when you're looking in the markets, you're basically looking for where has price sort of paused or corrected, just taking a breather. And then typically what you'll see is if it's demand, it's usually a bit of a pullback. So price is selling, right? It usually has a slight decline to it. And then boom, you see that buying pressure come in, and then you can either take the whole range or you can take the pivot, right? That's your demand. And then the exact opposite for supply. It's usually, that pause in the market, but it's usually slightly, to the upside. It kind of has that slight inclination to it, the incline, I should say. And then boom, that selling pressure comes in, right? And then you can take the whole range, or you can take the pivot from within it. And that's it. You don't really need to overcomplicate things too much more than that. Now, what I do say is with, when you kind of refine into a pivot zone, or you take a pivot zone, in terms of supply, the thrust candle is kind of what I'm calling the candle that initiates out. It needs to close. So this candle here, the body of the candle needs to close below the wick of your, let's call it your zone candle. I don't really know what else to call it, but your zone candle, okay? So obviously we're looking for a supply zone. We're looking for that buy before the sell. This candle here, this thrust candle, it needs to close below the low of here. Okay, so if you had an instance, this is going to look a bit weird, but if you had something like that, which can happen, okay, I would not draw on that supply zone. That's not valid supply. This only becomes valid supply once this closes. It literally has to close there. If it closes there, that's valid, right? And now I can draw my zone on from the high of the bullish candle to the low, okay, because this just about closes below the low. So that's valid supply, okay? Now, it's not the best supply in the world because what do we want to see? We want to see that kind of true commitment, right? When you see something like this, like momentum, that looks a lot better, right? That's price truly committing. Because if you get something like that, think about it, what's happened. Price has initially come out of the range, but then it's kind of come back up. There's more buying pressure coming in, which isn't as much, it's not as strong as if you see something really committing to itself. Okay, so the point I'm trying to make here is that your thrust candle, let's call it, should close outside the previous candle. Now, in this instance, when you get something like this, where you kind of get two bullish candles and price closes below both of them, then what you can also do is draw on, two candles like that. And sometimes there could be a third candle, and then, it's basically turning into range supply at that moment, but that's what you can do. But I personally, if I'm going to do that, I want to see price close below both of them, right? And you can have this in the market, and you can choose to refine it to one candle. You can choose to have it both. You will kind of figure out what you want to do over time, and we'll talk about that as we go on. But hopefully now you can kind of see the basics of what we're trying to do here. We're looking for where was there a pause in the market, and then did pure momentum come in, right, where an overwhelming imbalance between supply and demand has occurred, right? And ideally you want to see price, it needs to close above the previous candle's high if it's demand, and the previous candle's low if it's supply. And then once that happens, you can draw your zone on. Okay. Now, again, quick caveat halfway through this lesson. What we are doing now is we're not learning how to draw the best zones, the strongest zones, the ones that we want to trade from. This is just step one of how to draw it. As you go through the lessons, we're going to learn more and more confluence of what I actually look for. Okay. But yeah, that is range and pivot zones. And that's pretty much sort of the two main types of zones that we look at. Now, we're going to talk about actual trade entries in a lot more depth as we go throughout the course, and we'll have some dedicated lessons in that towards the end of the technical analysis module. But I want you to start thinking about, how is it we actually enter the market? And in its most basic sense, once we've identified a zone that we want to, trade from or build a trade idea around, let's imagine it's on our entry time frame. We're going to be entering on or within the zone, and our stop loss is always going to go behind the zone. Okay, we always want to protect it behind the zone. The reason why we want to put it behind the zone is because, we never know. Okay, easy way to explain it is if we're looking at range supply, let's just think about this, right? We know somewhere from the low of the range to the top of the range, that's where all of the supply came in to push price out of the range. But we don't know exactly where the biggest orders are within that range, right? So we know price could sometimes tap into here and it could go, or sometimes it could pull all the way into the top and it could go. We never quite know. So we always want to keep our stop loss protected behind the zone, okay? And obviously the opposite, if it was demand, we would put our stop loss behind the bottom, okay? So yeah, that's essentially what we're going to be doing for entries, stop loss behind, and we're going to enter on or, within the zone, depending on what you want to do, but we'll talk about that in more depth as we go on. For now, let's keep it very simple, and let's just always assume that once you've drawn your zone, your entry is always going to go on the front edge of it, right? The front edge, and the stop loss is always going to go behind, right? Let's just keep that simple for now, and we'll be consistent with that. Okay, so as you can see, we have this range created supply. And as you could probably guess, I've taken that exact same price action. Okay, so these exact same candlesticks, and then just copy and pasted it over here. But you can see how I've refined the zone to the pivot. Okay, so before you'd have had the range created supply, just like here. And what we can do is we can refine that to the pivot from within that. Okay, so you can see how price it comes up, it comes down, and you kind of get that last pivot, that buy before the sell. Okay. And in this case, I've refined it to the single candle pivot zone. Now, this type of zone, how I've drawn it like this to the single candle, this is probably what 95 to 99% of the time I'm refining my zones to, and especially with my entries. At the moment, at the time of recording, I like to enter on the single candle pivot zone, right? I don't like to refine it more than that, and I don't like to kind of enter on big ranges like this because, as you can see here, the more and more we refine the zones, what does that do? It allows our stop loss to get smaller. You can see the stop loss here is smaller than this stop loss. So what does that mean? It means my risk to reward is higher. Like for instance, if we were targeting all the same targets, here I can get a 4.24 risk reward. Here I can only get a 2.2 risk reward. So we're trading the same idea, we're trading the same zone, but by refining our entries a bit shorter, right, risk reward goes up, as you guys can see. And then finally, we're going to talk about fractal zones in a little bit more depth towards the end of the lesson. But essentially what I've just done is I've refined this zone to the wick. okay? And that can give you obviously increased risk reward. But as I've seen here, the more and more you refine, that can give us increased accuracy, right? Giving us higher risk reward, but it increases the amount of missed trades because, like I said at the start, we never know how far into this range or into the pivot price is going to pull before at some point that overwhelming imbalance is going to happen, where at this moment here, there is more supply than demand. So what happens? It overpowers it and we move to the downside. And then if you've over refined, then you cannot get tagged into the trade at all, okay? So trading is that fine art of trying to balance between, your risk to reward and your strike rate, and how many trades you want to be tagged into. So that's why I said for the majority of you, I would focus on pivot zones. It's a nice balance between being a bit more refined than taking the whole range and then not being over refined, okay? And this is a good balance for risk to reward and getting tagged into a lot of trades. And some of you also may want to take we get those two pivot candles there. You may want to do that as well. But for now, let's just keep it simple and think about one candle. So last point I'll make about this is, like I said, find a consistent balance that works for you, and it's super, super key to just stick to it. You need to be consistent. Hopefully you've watched the Trading and Edge module and you will know about random distribution, right? We never know the order of which our winners and losers will occur or when our edge will play out. So if you always take the pivot, try and be consistent with always taking the pivot. Don't flip and flop between when you're going to take the whole range and when not. Or if you do, sometimes take one and sometimes take the other. Have strict rules to know when you will or won't do that, okay? You need to define it so you can be consistent and be mechanical. Okay, so just before we kind of wrap things up and head onto the charts to practice drawing these and identifying these, we're going to start to think about the market in more of a fractal nature. So in those previous examples, we've just been thinking about one time frame. Now I want you to start thinking about multiple time frames, okay? So don't worry about market structure or premium discount or any of that fun stuff. Just think about supply and demand across a few different time frames. So let's look at this range created supply here, right? The examples we've just been looking at. Now, there's 4 candles here, right? Before the thrust candle, there's candle 1, 2, 3, and 4. Now, if you were to draw this range like this, let's say that we're on the 1 hour chart, okay? So this here is the 1 hour chart. So 1H, right? 1 hour, cool. So you've got 4 1 hour candles and you draw this range on. Now, if you were to jump up to the 4 hour chart, how do you think it's going to look? You guessed it, it's going to look like this candle. It's going to look like one candle, okay? Because obviously a 4 hour candle is 4 times 1 hour candles. And when you jump up a time frame, this is how that's going to look, right? Because it's the 4 hour candle opens here and then it closes here. So that's what happens. You get that bullish movement. That's what it looks like, okay? So when you draw a lower time frame range zone on, you don't even have to look on the higher time frame. You should be able to guess just by looking at this on the lower time frame. You should know in the back of your mind that that's a higher time frame pivot, okay? So a lower time frame range will be a higher time frame pivot zone, right? So like I said, yeah, when you see that lower time frame range, you should be able to visualize what that looks like on a higher time frame. And likewise, if you're sitting on the 4 hour chart and you see this, you already know on the 1 hour chart it's going to look something like this, right? It's going to be that range, okay? And I'll just put some examples for here. It's not really that important, but like I said, right, if there's 4 1 hour candles like this, then that's going to be 1 4 hour candle. Likewise, this could be the M15 chart. If you've got 4 M15 candles, that's going to be a 1 hour candle, right? And then some more slightly complicated ones for you. If there was 16, because sometimes you can get like a big range, right? You can get a long range like this. And let's say this is the M15, you're going to get 16 M15 candles, right? That will be 1 4 hour candle, okay? I think you guys get the idea, but yeah. Cool. Okay, and final thing I just want to talk through you guys is sort of those fractal refinements. So you remember before where we talked about, where we have range supply, okay? And then we can grab the zone and we can refine it to the pivot, right? Whether you want to take 2 candles or 1 candle. 1 candle is kind of what I recommend most of you just start with, just to keep things nice and simple. That's your pivot supply, and then you can refine it to have something like a fractal refinement. So there's kind of 3 main fractal refinements, which we can see here. First one is an inside bar. Basically that's, I hope you guys should know, right? When we looked in previous lessons, that's a candle that trades in between the high and the low of the previous candle, right? So it doesn't break the high low. So we get an inside bar, and then price breaks and closes above that. So if this thrust candle closes above the previous candle, what does that do? That gives us a demand zone. And that inside bar, right, if you look on a lower time frame, will typically be a range or sometimes be a pivot if you only jump down a very close time frame. But essentially what happens, right, is on this time frame, it just looks like price comes up, it comes down, and it comes up, right? But that quick pullback that only lasted one candle on this time frame, if you were to go and look on a lower time frame, right, it's going to be multiple candles. Okay, exact same for supply. Price comes down, it comes up, and it comes down. On a lower time frame, that will be a range, right? Now, you can draw it on the inside bar. This is a very minor detail, but you can also draw it from the low of that candle to the top of the candle, okay? If you just want to include that as well. Sometimes I'll do that because what can happen is price can come in and it can tap that low and continue, rather than it doesn't always quite reach the inside bar, okay? So it's a bit more of that range, right? Because what happens is price comes down, you then get that buying pressure, and then boom, the supply steps in, right? So from the low of where the pullback started to the top of the pullback, that's your supply, okay? So sometimes if you see price action like that, where the low is so near here, I don't over refine, and I'll just take that whole area as supply, okay? So that's inside bars. Sell to buy wicks. This is where it gets a bit more interesting in terms of kind of true fractal zones, whereby if you just see two bullish candles, a lot of people won't realize that there's actually valid supply in the middle of that. And the reason why is if you think about how the candles are formed, okay? So we have this bullish candle here, it opens here, right? So it opens where my mouse is, probably trades down a bit, then it goes up, right? And then it pulls back a little bit, and then that's where the candle closes. So we have a bullish candle. Now, what happens in the next bit is the next candle starts and price trades down, right? So it continues the down movement from that wick, it comes down, and then it goes up, and it pulls back a little bit, okay? So if I just draw that to the side, what's happened between those two candles is, again, just like the inside bar, we've had an up movement, we've had a bit of a pullback, and we've had a continuation. So that sell to buy, right, that little pullback, what's that going to be in a lower time frame? You're going to likely get a range or maybe a single candle, depending on how near of a time frame you're looking at. But essentially, that's what we're looking for. And that, from the top of the reaction, or the top of the pullback to the bottom of the pullback, that's your zone. That's where the demand stepped into the market. That's your sell before the buy. So whenever you see wicks like this, you can draw in a zone and realize what it is, that it's lower time frame demand. And the likewise for supply, right? Price comes down, it pulls back, and it continues down. So that buy before the sell, that is your supply. And if you look on a lower time frame, it will look something like this or like this, okay? And then last but not least, we have wicks. And sometimes you can draw this on, like what you'll see in the live market is you'll get sort of normal sized candles, and then sometimes you'll get this big candle with a big wick like that. And if you should take the whole pivot, it can be quite a large zone. So sometimes what you can do is you can just refine the zone to the wick, just to be a little bit more refined, right? If you want to kind of increase your risk reward and your accuracy, right? And again, if you look in the wick on the lower time frame, it will look something like this or something like this. So I think you guys get the idea. Now, the final and only key point I want to make about these fractal zones specifically, and more so about the two types of wick zones here, is that I don't view them, or at least in my experience in my testing, I don't view those types of zones as strong as a normal type of pivot zone, okay? So imagine, just think about one time frame now, right? 4 hour zone. Imagine these are all 4 hour candles, okay? If you had like a proper, imagine, I know this is low time frame, but imagine this is the 4 hour zone and you have a 4 hour full bodied, a full candle body zone like this, a full pivot zone. That to me is like a proper 4 hour zone. It's a true 4 hour supply zone, right? If we then have this on the 4 hour chart, it's 4 hour wicks, but it's not really like a 4 hour zone. It's not a proper 4 hour candle zone. This to me is just a way of viewing that there's an M15 supply zone here, but I can see it on the 4 hour time frame. Okay, so if I had the option from trading from 4 hour buy to sell wicks like this, or from trading from a 4 hour pivot candle zone like this, I'm always going to want to pick this zone. This to me holds a lot more weight. It has a lot more orders within it than just reading the buy to sell wicks, because remember, time is power. The 4 hour chart is more powerful than the M15. This to me, this is a 4 hour zone here. This is a 4 hour pivot zone. Buy to sell wicks, that's an M15 zone, but it just so happens that I can see it in the 4 hour chart, okay? So I'll be aware of these and I'll draw them on my charts, but I don't view this as strong as a proper 4 hour, candle pivot zone. Hopefully that makes sense, okay? So yeah, that's kind of all the sorts of ways in which we draw zones. For some of you who are new to supply and demand, this might seem quite a lot to take in. So rewatch it a couple of times, but in the next lesson, we're now going to go through some examples on the charts of how we identify them and draw them.